Hi everyone, a very warm welcome to this presentation on the financial markets. I sincerely thank each and every one of you for attending today, and hopefully you'll walk away a more knowledgeable and informed trader. Now, I have to be clear, today's session is an introduction, meaning I'll avoid going into too much detail as it can quickly become confusing, especially when diving into the weird and wonderful world of derivatives. So really today is ultimately aimed at newer traders. You will find as you progress and advance in your trading that this business is an ongoing learning process. I think, excuse me guys, I think Albert Einstein said it best, life is like riding a bicycle. To keep your balance, you must keep moving. And I kind of apply this to my continual study of markets and strategies to navigate the ever-changing marketplace. We will, of course, if there's demand for it, consider producing part 2 and even part 3 to this, given the detail involved. Guys, so I know I'm not just talking to myself. Could you please let me know if you can hear me and see the welcome slide? Okay, excellent. Thank you, guys. So just to quickly introduce myself, so we all know who's behind the mic. My name's Aaron Hill and I work with FP Markets in their research department. I've been involved in the financial markets for around 12 years now and remain as eager as I did when I first laid eyes on a chart. I actually began trading in the stock market but quickly found the derivatives market more appealing. This of course was influenced by the two traders who helped me, who are both consistently successful traders and who I considered my mentors and remain my friends to this day. Also, for anyone interested, I'm in the final stages of the CMT program, so any questions on this course, please feel free to ask away. I also have plans to enroll on the CFA program next year, so it would be cool if anyone here has had any experience with this to maybe even drop me a message or and let me know how they found it. For anyone interested in a recording, each webinar is recorded and stored on the FP Markets website under the Resources tab on the main menu and is also uploaded to our YouTube channel. So, as usual, let me just quickly run through the disclaimer on screen. The information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. FP Markets has made every effort to ensure the accuracy of the information as at the date of publication. FP Markets does not give any warranty or representation as to the accuracy, reliability, or completeness of the information contained in this material. So look guys, really what this disclaimer is telling us is that anything I discuss here today should be taken as educational content and not direct financial advice. So as for topics, for the first 3 subjects, I plan to merge them as they all pretty much relate and can be discussed together. So that is a definition of what the financial markets is, why do financial markets exist, and who are the main players in the financial markets. The last part, an outline of the major financial markets. Sorry guys. The major financial markets will be my attempt to briefly describe the following financial markets. So the stock market, the bond market, the foreign exchange market, and the foreign exchange market. I also plan to touch on the derivatives space as well. Guys, as for the Q&A, I know I usually take questions throughout the webinar, but as I have a lot of information to get through, can I ask you to sit back, grab a coffee, and note down any questions at the end, for the end. This will ensure I'm able to go over everything in the presentation. Also, guys, although I've been in the business for more than a decade, I am, like all of us here, still learning. If a question is posed I am unsure of, I will not guess. I will simply say I'm unsure, and I will find out the answer for you and either send you a personal email, excuse me, guys, or highlight the response in future webinars. So with that out of the way, let's move on to the first point. What are financial markets? Why do they exist? And essentially, what are their primary purpose? Right, broadly speaking, financial markets refer to a marketplace where the practice of trading securities takes place. Most people think about the stock market in terms of financial markets, but this is only a piece of the financial pie. I also have to be careful with the term securities here. Securities for me can be characterized into three distinct types. That is equity securities, debt securities, and derivatives securities. So while many of us know securities to mean financial instruments, assets that can be traded, its definition can vary depending on the country. For example, here in the UK, the definition according to the Financial Conduct Authority, the FCA, which is a regulatory body, only refers to equities, debentures, and bonds as securities. I have a link for you guys to look at this in more detail if you want. I'll just give me a second and I'll place that in the chat box for you. Okay, so in the US, the term securities actually refers to any tradable security, tradable financial asset. And this is according to the US Securities Exchange Act 1934. In fact, I believe the 1934 Act also established the Securities and Exchange Commission, from which most of us will know to be the SEC, an organization that enforces securities law against, I believe, market manipulation. For anyone who wants to double check this or simply fancies furthering their understanding, I'll throw a link to the SEC website and also the Federal Deposit Insurance Corporation website link. Just give me a second, guys, so I can get this to you. And one more. So yeah, take a look at those if you have the time. So look, I am by no means an expert on securities, and I'm sure other countries have different rules around this term. So if anyone sees something they feel may be incorrect, please let me know. But for the purpose of this presentation, I think it's best to follow the US definition to avoid confusion and keep things as simple as possible. So as I briefly noted, the financial arena provides a platform, shall we say, for trading, essentially to fulfill a number of different functions. So you could, in simple terms, simply think of markets as a combination of investors, so those are the lenders, and borrowers, which are those who essentially issue securities. Common financial markets are the stock market, the bond market, commodities market, foreign exchange market, and the derivatives market. Right. So why do they exist, and what's their purpose? So look, the euro traded higher against the greenback today, or the S&P 500 index fell 100 points. Or US Treasury government bonds fell, pushing the 10-year yield above 1.6%. 1.6%. Or Bitcoin traded past 80,000. Who knows? The point is, each of these events, for the purpose of this demonstration, are functions of the financial market. As I'm sure you can imagine, guys, the markets influence our lives in many ways, from investing to going abroad. For example, so think of when you go to when you exchange currency at the airport. That's a prime example. So look, financial markets are not anything new. They've been around for centuries. I won't go into detail, as a simple Google search would be enough in regards to history if you're interested. Now, the size of the financial markets is always intriguing. So look, take the foreign exchange market, for example, the largest financial market in the world. The 2019 triennial survey of turnover in OTC FX markets revealed trading in this market reached $6.6 trillion per day in values here, just under $6.6 trillion per day in April 2019. This was up from just under $5.1 trillion 3 years earlier. Please feel free to check this out. This survey contains a truckload of eye-popping info. Just give me a second, and I'll throw this link across for you guys. Just a second. Okay. Now, I won't go into the size of other markets at this point, as this could be touched on in part 2 or even part 3. But just know the FX marketplace commands the greatest presence, if you will. So I always think of the financial markets in this way. They're simply in place to connect the right people to each other at the right time. So a common example to help describe this, of course, is when companies look to expand. They require finance. Companies can choose between two major money-raising options. So basically issuing stocks and issuing bonds. Some companies choose to issue stocks to raise money. Unlike bonds, the money that the company raises through a stock offering isn't paid back because it's not essentially a loan. So financial markets are also a place where companies reduce risks. Governments can seek additional funding, and it's also a location for individual investors who can save for retirement. We also know it's a place for speculation and hedging. You know, hedging can be done through derivatives like options contracts, and also diversification in terms of correlation, or should I say uncorrelated markets. This is certainly something we can touch on in future webinars if there's demand. Okay, moving swiftly on. The subject of financial regulation should also be taken into account when studying the framework of financial markets. So look, some of the major financial regulatory bodies, or often referred to as financial watchdogs, are the FCA, the Financial Conduct Authority here in the UK, the SEC out of the US, which is the the Securities and Exchange Commission, and the Australian Securities and Investments Commission, or ASIC in Australia. Look, guys, I don't want to deep dive too far into the regulatory components, as you can imagine, this would be beyond the scope of this demonstration. But for the purpose of this introductory piece, just know financial regulatory bodies are there to govern actions of securities firms as well as other institutions. They essentially set standards which all under their jurisdiction must comply with. So look, who are the main players in the financial markets? Well, as you can see there, on the slide, there are a handful. So look, central banks are major players, of course. A key role of central banks is to conduct monetary policy to achieve price stability, so low and stable inflation. So essentially to help govern economic fluctuations. Institutional investors and institutional traders, of course, are another major component. Think insurance companies, mutual funds, hedge funds, pension funds, and large investment banks. These are responsible for most of the trading in financial markets. And we also have individual investors, the likes of me and you. You could even say we are retail investors to a point. So collectively, though, individuals own a small portion of financial assets. Most, especially in wealthier countries, own some financial assets, and this is often in return in terms of retirement savings, but nevertheless, most holdings are quite small. In fact, I found that direct ownership in the US of stocks increased slightly between 2016 to 2019 to more than 15% of families. This was according to the Federal Reserve Bulletin. I have a link here if anyone's interested in checking it out. It's quite a lengthy document, but it's full of interesting facts. I'll swing this across to the chat right now, guys. Sorry for all the links today, but it's good to follow up if you feel it's necessary. So look, I'm sure you're all aware technology has significantly increased the opportunity for retail involvement in all markets. So infrastructure, so think internet speeds and lower barriers to entry are two key points. Everyone can now access the markets, which can be a good or a bad thing, as I'm sure you understand. Right, we have a question here. Is the audio working? Guys, can you just let me know? Can everyone let me know? Just ping Y or N across and let me know if you can hear me loud and clear, as it might be a problem on the side of the attendee. Yeah, okay. Yeah, sorry. I think the audio might be a problem on your side. I'm not sure. All right, thanks, guys. Okay, let me just swing this across. So okay, thank you, guys. Excellent. So the plan now, as that has taken up quite a bit of time, is to describe the various financial markets in a little more detail. As I said at the beginning, if you feel part 2 is needed, let us know, and we'll be happy to piece something together. For the stock market, we can look at equity as simply translating to ownership, right? So the stock market is part of what's known as the capital market. Capital markets essentially transfers capital from willing investors to businesses that require capital to finance various projects or investments. So look, capital markets, although some may have a different definition, primarily consist of two types of securities. So we have equity securities and debt securities. Both are forms of investments that provide investors with different returns and risks, of course, and provide users with capital and, of course, different obligations. As I said, equities form a part of ownership of a company. Basically, this represents owners in the this represents the owner's investment in the firm, while debt or bonds are more of an IOU. So look, the main function of the stock market is of course raising finance or raising capital, as it's more commonly referred to. So the stock market's history is long and colourful, dating back centuries. Through my own research, I found the first shareholder-owned business appears to have been founded in the early 17th century, called the Dutch East India Company. The company issued certificates that were readily tradable in Amsterdam. As I'm sure you can imagine, it's beyond the scope of this webinar to delve too far into the history, but I certainly recommend checking it out, as by the late 17th century, I found that there were traders in London coffee houses earning money through dealing in shares. Now, the New York Stock Exchange, or NYSE, is the largest stock exchange in the world, with an equity market capitalization of just over 25.6 trillion US dollars as of February 2021. This was published by Statista Research on May 11th of this year. This, as you can see from the slide, is followed by the Nasdaq, Hong Kong exchanges, and the Shanghai Stock Exchange. As you can see, the NYSE and the Nasdaq dwarf other markets, other stock markets. As you can also see here, US equity markets represents 39% of the of the $95 trillion in global equity market cap, or $37.5 trillion. So guys, look, this is nearly 4 times the next largest market, which is the EU at 10%. The data, this data was taken from the Capital Markets Factbook 2020 from SEMFA, or the Securities Industry and Financial Markets Association. Look, guys, I will ping across a link very shortly to this, but I plan to do that later on in the presentation. So look, for those of you unaware of what market cap or market capitalization is, it's simply the dollar value of a company's outstanding shares of stock. So how much a company is worth as determined by the stock market, and is equal to the current share price multiplied by the number of shares outstanding. Now, look, guys, just quickly, shares outstanding simply refer to a company stock held by all its shareholders. Now, let me just spin across. Right, so the types of equity are interesting. Without getting too technical, we have what's known as ordinary shares here in the UK, or common stock, what is known in the US. And these are important to understand. Owners of ordinary shares are part owners of the company and entitled to vote on important company matters. This is basically what I call traditional share dealing. Dealing in physical shares of a company. This is obviously not the same as trading derivatives contracts, guys. So when it comes to trading in physical shares, shareholders hold the right to a share in a company's income and assets, and can also receive dividend payments. However, trading the stock market through what's known as a nominee account as a beneficial owner will have no voting rights and cannot, unless I believe you're registered as a guest, attend the annual general meeting. Guys, while it's still possible to receive share certificates, excuse me guys, 1 second, receive share certificates, nowadays most traders work with a nominee account. This ultimately permits the stockbroker to hold the shares on behalf of the trader, making buying and selling shares a smoother process. The broker, therefore, is the legal shareholder, with their name actually appearing on the share register. So in addition to ordinary shares and common stock, we have what's known as preferred stock. But given the time constraints now, we can go over this in part 2 if required. Other important features we can touch on, of course, are the primary and secondary markets, which are computer-based electronic platforms. Look, so in brief, the main goal of a primary market is to raise new money. This is a common strategy for governments and companies. Securities like bonds and stocks are first sold in a primary market, usually to institutional investors, such as hedge funds or mutual funds. I say usually because there are times when IPOs are open to retail investors as well. An example of a primary market is, of course, IPOs, or initial public offerings. So the main purpose of a secondary market is for people to be able to resell the securities created and sold from a primary market. And look, guys, the secondary market is what most of us watch and trade if we trade in physical shares. And the secondary market contains the existing or already issued securities, and these are traded between the market players. Now, do take note that companies that initially issued shares in an IPO do not have a part in the secondary market. The New York Stock Exchange and NASDAQ are examples of secondary markets. Right, okay. So, right, the debt market or bond market. So look, I'm going to try and keep this a little shorter, as time is really creeping up on me now. So here we're looking at what's known as the bond market or debt financing, or sometimes called fixed income, which simply means an investor who purchases a bond from what's known as an issuer. The issuer might be the government, a company, or some form of organization, for example. So a bond essentially represents the issuer's pledged promise to pay interest and repay the principal according to the terms set out. Guys, the principal is simply the amount of money the issuer of a bond is borrowing. Okay. Now, I believe bonds are the most widely used financial instruments. US fixed income markets consist of nearly 39% of the, excuse me guys, just one second, I'm checking the slide. Yes, so US fixed income markets consist of nearly 40% of the nearly $106 trillion securities outstanding across the globe, or $41 trillion, if you will. You know, this is nearly 2 times the next largest market, which is the EU again, at 21%. This data was taken from again from the Capital Markets Factbook of 2020 from CINFA. Guys, if you're interested in getting your hands on this factbook, I will now throw a link across to the chat box, as it shows the data for both bonds and equities, which I mentioned earlier. Just give me a second. Bear with me. Okay. So look, bonds are generally branded as, you know, I have to be careful here because obviously we all have our own opinions, but I've seen many people, many investors and traders state bonds as dull investments, and they're only for conservative investors. I personally disagree, to be honest. They can be viewed as what's called defensive or safe haven instruments when when markets essentially become unsettled. I'm largely referring to government bonds, guys. You will note at times at times US Treasury yields track US stocks. So for the S&P 500, as traders dump bonds in favour of risk, but you know, the correlation is far from perfect. Other safe haven assets might include gold and other precious metals, certain currencies, you know, think the US dollar, the Japanese yen, and the Swiss franc. And even some areas of the equity market are commonly called defensive stocks. Some of these examples are utilities, consumer staples, and things like healthcare. So I believe the theory behind this is that irrespective of the condition of the markets, people will still need access to, you know, utilities, gas, electricity, power. People will still be purchasing staple items like, food, as we learned throughout the COVID crisis, right? And people still need, people will always need access to healthcare. So back to bonds. Who are the main issuers? So look, national governments, which are also called sovereigns, are the main players, of course, and are generally considered the more secure, as they are backed by the fourth faith of and credit of the government. The most famous, I guess you could say, are US Treasury bonds. You have with this we have US Treasury bills, Treasury notes, and Treasury bonds. And these are often just called treasuries. The difference between bills, notes, and bonds are the lengths until maturity. Treasury bills are issued for the terms of less than a year. Treasury notes are issued for terms, I think it's between 2, 3, 5, 7, and 10 years. And Treasury bonds are issued for terms of 30 years. So look, it's important to note that bonds are also issued within governments as well, which are called semi-sovereigns. So think a municipal bonds, which are debt securities issued by a state or county to finance its capital expenditures, which includes things like construction of highways, bridges, and schools. We also of course have the corporations, which we can go over in another webinar if required. So guys, I don't see any questions coming through. I did say at the beginning to hold your questions. Thank you guys for respecting that. Okay, look, swiftly moving over to the foreign exchange market, or more commonly referred to as the FX or Forex market. No doubt most of us here are aware of the FX arena, so I will try to keep this short and sweet. So look, previously FX was restricted to large financial institutions and wealthy investors, but thanks to modern technology, retail FX trading has grown. Some of the major players in FX are central banks, large commercial banks, large investment banks, the likes of JP Morgan and Goldman Sachs. We also have large export and import organizations, as well as speculators and investors. Guys, just real quick, commercial banks essentially provide, just to help understand this, so commercial banks essentially provide banking services to the likes of us, households, and business customers, while investment banks fill a number of different functions, including market making and raising money by selling securities such as shares or bonds to investors. These banks are sometimes actually referred to as sell-side entities. Primarily, the FX market is where currencies are traded. So think the US dollar, Europe's single currency, Britain's pound, or the Japanese yen. This market essentially connects with all other financial markets, influencing things like trade with other countries, in international investment, and of course inflation. FX markets effectively operate in all corners of the world today, and this market has a relatively colourful history, which is certainly worth checking out if you have the time. So look, currencies in the FX market are quoted in what's known as pairs. This is mainly for newer traders, guys, so please do bear with me. So look, one currency is quoted against another currency, hence the term currency pairs, which I'm sure most of us would have already heard. look, really, all the currency pair tells us is the amount you pay in one currency for a unit of another currency. As a simple example, look at the euro dollar, which is a similar format you'll see on most major trading platforms. And essentially just take note that it contains two currencies. We have the euro and we have the greenback. The first currency, the euro in this case, is referred to as the base currency. And now the base currency is what we as traders trade when we buy and sell a currency pair. And do note that this unit here always represents one unit of currency. Over the other side, the second currency is what's known as a counter currency. Look, guys, sometimes traders refer to this as the quote currency or secondary currency. Now, the secondary currency is what the base currency is valued in. So if you buy euro dollar and price advances, the gains are not represented in euros, but they are represented in dollars, the quote currency. It's also worth touching on a concept known as direct and indirect forex quotes. Really quickly, to put it simply, whether a quotation is direct or indirect depends on your location and domestic currency. Using the euro dollar again as an example, if I was in Europe and using the euro as my domestic currency, the euro dollar is a direct quote, as it directly informs me of how much 1 euro is worth, which in this case obviously is $1.20. Remember, the base currency is always one unit of currency. We have a comment here. The audio is still not working. Thank you for having me anyway. Oh, I apologize. I'm not sure what went wrong there. Okay. So look, now an indirect quote would be using the euro dollar again for someone out of the US looking at the euro dollar exchange rate. It indirectly informs us that to purchase one euro, it will essentially cost $1.20. So basically, you would not be provided with direct information in that how many US dollars can be bought with 1 unit of your domestic currency without calculating it, of course. This can be easily done though. Simply divide the base and the quote. So in this case, 1 divided by 120 gives 83 cents per euro, and that's rounded. Okay, another point worth going over is where currencies are traded. Currencies for immediate delivery trade on what's known as the spot market, though the actual exchange of physical currencies, physical cash, the currencies occurs 2 days following trade agreement. Obviously, the FX market is the excuse me, guys, is the largest spot market in the world. Other assets also trade on the spot market, which are equities. We also know debt, Treasury bills, for example, is also traded on the spot market. Commodities also trade on the spot market as well. This is something for another time, but just be aware that that it is not only the FX market that trades on the spot market. So look, spot market transactions can take place on an exchange or over the counter, or sometimes called off exchange. Exchanges are organized, at physical locations and electronic locations, of course, highly regulated to offer transparency and provide efficient trading conditions by centralizing the buying and selling. Conducted electronically, an OTC market that has market participants trade directly with one another, no exchange or central clearinghouse exists. Dealers, what's known as dealers, essentially quote tradable bid and ask prices. Now, guys, what are dealers, what are market makers, and what are brokers? There are a difference. So a dealer will usually be on the other side of the trade. You know, I always try to think of this as similar to a car dealer. You'll be buying or selling with the dealer himself as the counterparty. So a dealer essentially takes the other side of your trade. A broker, a broker, or let's go to the market maker first. The market maker, on the other hand, is who stands in the market as almost as a bridge between the buyers and sellers. So a market maker is often obligated to make markets in specific securities, meaning they both bid to buy and offer to sell the stock market, the stock or security at the same time. Remember, as traders, we actually sell the bid and buy the offer, while the market maker buys the bid and sells the offer. So finally, onto a broker. A broker is essentially a middleman between the investor and market. For example, if you claim you are going to buy 1,000 shares of Facebook or Apple at $114, for example, how does the exchange know you're going to honour your trade? And how does the exchange know you actually have the money to pay for the shares? Your broker makes sure to only execute trades that you can afford. And in the case of derivatives, it makes sure you have enough margin so that when you need to pay the counterparty, you are actually going to honour that contract. Finally, I want to briefly highlight the FX market's hierarchy, if you will. This is an interesting topic which could serve well for a portion of part 2 if we go ahead with this. At the top of the pile, of course, we have central banks, which are not highlighted on this slide, but just know that at the top of the pile, central banks exist. Think of the US Federal Reserve and the Bank of England here in the UK. We then switch to the interbank market, so the wholesale of FX pricing, if you will. And these are key market makers in the FX domain. They provide prices at which the bank commits to buying and selling currencies from their peers in the interbank market. Though these prices are intended for the interbank market, they effectively filter their way down to the retail side of the market. Therefore, we can say the institutions that consist of the interbank market are primary market makers of the FX market, in the FX market. The trades between large banks form the core of the FX market's volume. One of the foundations of the interbank market is the credit relationships that the largest banks have between each other. The banks buy and sell currencies between each other on this credit basis. Furthermore, deals in the interbank market are typically very large. These aspects combine to exclude most players from directly accessing the interbank market. Thankfully, retail clients can now readily access the FX market. They do this largely through FX and CFD brokers that directly and sometimes indirectly tap into prices made by large banks, the market makers. This trend has been the growth of retail trading, as I mentioned, has been aided by improvements in technology. Now, just really quickly onto the derivatives markets. So as you can see on the slide, the most common types of derivatives are forwards, futures, options, swaps, and of course CFDs, or contracts for differences, which is what I'm sure most of us here are trading with or have traded with in the past. And as you can see, the most common underlying assets include commodities, stocks, bonds, interest rates, and of course foreign exchange or currencies. Derivatives contracts can either be It can be either over the counter or exchange traded. It's also important to understand derivatives contracts are either cash settled or physically delivered on the expiry date of the contract. Just be aware, CFD contracts, which you'll trade with FP Markets and other brokers, are only cash settled. There is no physical delivery of currencies if you're trading, assume we're trading the FX market. So a key appeal to the derivatives market, of course, is leverage. Leverage is often defined as borrowed funds to increase trading position beyond what would be available from a cash balance. Technically, this is not true, as far as I'm aware. This is not true, but is true for if you're trading physical shares, for example. So in the case of Forex, your broker allows you to use leverage by letting you only put up a small percentage of the position size, and this is referred to as initial margin. Think of it as a deposit to almost trade. In FX, we do not trade the underlying market. We trade derivatives in the form of contracts based on the underlying market, namely CFDs, as you would with FP Markets. So look, with leverage, it represents the ability to put on a position larger than your available funds. Therefore, as I'm sure you can imagine, greater returns are possible when employing leverage, though we also have to take into account that there's increased risk of larger losses as well. Now, a common misconception, just really quickly, about trading with leverage is that the leverage a trader receives is a loan in CFDs. I'm assuming the same goes for futures and options contracts as well in terms of leverage. I guess I can see why many traders believe leverage to be a loan, largely due to most educators pumping this out as fact. The broker, or FX spot trading that is not lending you anything. There's not some guy, some cashier somewhere loaning you 100,000 US dollars or British pounds for a standard lot if you put down £1,000, 1%. That's not how it works. I'll go into detail about this in a previous webinar if you're interested. Right, so finally, Q&A. Guys, do you have any questions on anything that I've put forward today? Now's the time. Okay, if not, I can go over a quick example about the leverage I just mentioned, because there's a lot of confusion surrounding this. So look, where does leverage come from, and how do we trade larger positions? Well, you're not borrowing money from the broker, as I said. Instead, you're trading on what's known as margin. So look, as an example, a really quick example, if we trade one standard lot on euro dollar, that's 100,000 units. We are, with a euro trading account, trading at $10 per pip at leverage of 1 to 100. This requires we put down 1% as initial margin, so 1,000 euros. This allows you to trade a larger position, therefore increase your exposure. Should your account take on losses and your equity falls below used margin, which is 1,000 euros, the provider has what's known as a margin call. Now look, a margin call occurs when the equity drops below 100% of margin used, and this is simply an alert for the trader. The stop out level is what's important for clients, and it's usually 50%. FP Markets actually work with a 50% stop out level, which means if equity falls below $500 or 49.9%, FP Markets will actually close the most losing position out. So we have a question or a comment. I know you already said it. I'm sorry to ask again, but who is market movers? Market makers, I assume. Market makers. Okay, so look, simply a market maker Yeah, market makers. Okay, no problem. So the major market makers in the FX domain, of course, are the large investment banks. But look, a market maker, as I said, essentially is a bridge, right? It creates a bridge between buyers and sellers. And there, oh no, sorry. Yes. So what they do is they buy at the bid and they sell at the offer. But we actually sell at the bid and buy at the offer. Who is the market makers exactly? So as far as I'm aware, as far as I know, the major market makers, just to answer your question, are the major banks, and this filters down to the retail side of the market. So as you can see on the, I think it's a slide. Which slide was this? Here. So these major banks are the market makers, and this is part of the interbank market. And as you can see, this fills the FX and CFD providers, for example. And obviously, this is what we see, us guys see. We are the traders, and we see the quotes provided from the FX and CFD providers that they themselves attain from the major banks, which are the market makers. Okay. Let me just spin back to the. Okay, I don't see any more questions, so I assume we're either all very confused or understand everything I've gone over. So look, I'll end it here then. I hope this presentation has opened some eyes to how diverse the financial markets are. Look, guys, do you feel that a part 2 is necessary to this, or a part 3? We can go over each market in a lot more detail. We can touch on, the stock markets, for example, and the different ways it can be traded, and essentially go over more sections of that particular market, such as the organisation of a stock exchange, or we can look at different leverage offerings and the functions of the FX market, for example. If there's a call for that, let me know, and we'll put something together. Okay, so with that, I'm going to sign off. So I hope this is all, as I said, I hope this presentation has been of benefit, and thank you all so much for taking the time out of your day to be with us. Have a lovely day, and goodbye.